Welcome and good afternoon, everybody. My name is Patrick Barry. I'm the Director of Wealth at the Partners Wealth Group. Thank you for joining us today on our presentation in relation to limited recourse borrowing arrangements. Partners Wealth Group, for those that you don't know our business, we're a business that is a diversified financial services business that specialises in wealth solutions, legal solutions, SMSF, lending and private assets. Today we'll be talking about limited recourse borrowing, how effective that structure works and what we see the future with that structure. Partners Wealth Group has over 90 employees, and next year we'll be celebrating our 20th birthday, which is something we're looking forward to celebrating. Before we go into the details of the presentation, I think it's important to let everyone understand this is actually a general presentation. Please don't go and act on any advice that anything we discussed today. It's not personal advice, it's general advice for everybody. Today I'll be joined by three other presenters who are professionals in their field. James Thompson from Partners Lending, he's a general manager, and James will be talking about the nuances of this arrangement, given the lending is a little bit different than your standard commercial or residential loan. Marianne Davies, who's a property partner at Partners Legal Solutions, who'll be talking about the stamp duty implications and sort of focusing on the real importance of making sure the documentation is done correctly, because you don't want to have a situation where there's double stamp duty payable. And Phil Almeida from Performance Property. Phil is a director of that business. They're a research-led property advisory business that specialises in fires advocacy, property management, research and funds management. So the agenda today, what we'll be talking to, I'll provide a little bit of the history of the limited recourse borrowing arrangements, about one interesting story. I'll sort of touch on what our house view is on the future of this arrangement. We'll talk through how the structure works and the requirements, what documents and legal agreements are required. There's actually quite a few. There's supposed to be about 10 or so different documents that are required in legal agreements. That's what's really important, we think, to make sure you receive correct advice in relation to structuring this arrangement. James will be touching on lending and talking about the market, when we're saying the bank's exit, etc. Duty implications, Marianne will talk about that. As I said, it's really important to make sure that these documents are structured correctly to make sure that trustees and members aren't hit with excess tax. I'll run through a bit of a case study just to show the benefits of this structure, and I guess the benefits of having a gearing structure within a self-managed super fund and that generous tax environment. And then Phil will be providing a property update, which I think is quite timely given the interest rate rise we've seen, and one yesterday from the RBA. So the history and the future. So the ability to actually use borrowings in a superannuation fund commenced in 2007, and this was actually off the back of the Telstra instalments. I think most people would remember T1, T2 and T3. Prior to 2007, there was a ban on any self-managed super fund using borrowings to acquire an asset. And I think by default, many Australians with their self-managed super funds went out and purchased T3 instalments, which effectively allowed that super fund the right but not the obligation to acquire the full Telstra shares by making a down payment. There was thousands of these in different funds across Australia. And the industry looked at and thought, hang on, these funds are in breach of the borrowing provisions. So the industry went to the ATO and said to the ATO, what do we do here? It seems like we've got thousands, if not tens of thousands of self-managed super funds in breach of the legislation. And the ATO actually came back and they actually said, you're allowed to use an instalment warrant to purchase any asset in the superannuation fund that you could usually use cash to purchase. So that sort of opened it up to property, commercial property, residential property, cars, collectibles, and I think even back then it may have been golf memberships were allowed as well, but I think that's all changed now. So off the back of that, we went out, Partners Wealth Group, I think we're one of the first businesses in Australia to actually provide advice on this. We went out to the banks, we found that banks were quite slow to understand the arrangement. Now I think the reason for that is because of the fact that it was a limited recourse borrowing arrangement. The bank could only take charge over the asset was being purchased with the borrowings, and as we know, banks like to tie up every single asset, every family member and even the unborn child when it comes to lending money. So for them, it actually took a bit of a change to their thinking to actually allow their risk committee to actually allow the loans. It has been a very popular wealth creation strategy. I don't think it's been one that's been abused. In 2020, the latest research shows that about 10% of self-managed super funds have entered into this arrangement. That equates to about $44 billion worth of assets. So definitely popular, not overused, and something that I think in the last 20 years has led to some considerable gains for clients in their self-managed super fund, given the performance of the Australian property market. Also, PWG, given our specialties and the fact that we have a house of specialists where we can provide advice around every part of the transaction, we've actually helped clients and our referral partners enter about 1,500 of these limited recourse borrowing arrangements since 2007. So where to the future? Our house view is that we think that this strategy may be banned or come under a bit of pressure
from the new government. We know that
Labor went to the 2019 federal election with quite a few policies in relation to different areas, such as negative gearing was going to be abolished, franking credits were going to be stopped, and also one of these policies was in relation to this limited recourse borrowing arrangement. We haven't heard much from the government on this, but our view is that perhaps this may be taken away at the election. At the budget in October 25th, or there may be a bit of a limited time frame on the ability to do this arrangement. What we have seen in the past, whenever legislation has changed, it's not retrospective, so we are comfortable to think that any clients that have entered into this arrangement prior to the change in legislation will not be impacted by any future legislative change. So there may be a bit of a time frame and the ability to actually undertake this strategy, which we've seen has created great wealth for many Australians. So the limited recourse borrowing arrangements really covered under Section 67A of the SIST Act. And there's a few rules around what can and cannot be done. I think one of the important things to touch on is the fact that you can only use an LRBA to have a single requirable asset.
So what that means is if you go out and buy
property across 2 titles, a bunch of units, etc. It has to be one asset sitting within the bare trust, and that's that second point there. So the asset actually cannot sit within the self-managed super fund. We see a lot of issues where clients have gone out and they've actually signed in the name of the self-managed super fund, thinking the superannuation fund should be on title. It's not. A second trust has to be set up, a bare trust, which allows the superannuation fund to actually enter an arrangement with that, with they're the beneficial owner of the asset sitting in the trust, but the asset's not sitting in the superannuation fund. And that allows, the superannuation fund to get away from that restriction on the superannuation fund being encumbered or having a bank hold title on that. As I was mentioning before, the right of the lender is actually limited to the acquired asset. So quite a good strategy where you're not putting at risk other assets within the self-managed super fund or personal assets. And the superannuation fund trustee has the right to obtain legal ownership after the borrowing has been repaid. So that's effectively how the structure works. This diagram here now I think is quite useful to actually show how the structure works. There's a fair bit going on in there. It does look complex, but once it's all set up and in place, it's effectively just
like having investment property owned
in a structure. So the piggy bank there is a self-managed super fund. A separate trust has to be established, which is that holding trust, which sits below the self-managed super fund, and that's effectively called a bare trust, and that's where the asset sits. In this example here, was used a property. It looks like a residential property. Effectively, the property sits in the bare trust there, and there's an agreement drawn up between the super fund and the trust saying the superannuation fund has a right to acquire the asset in the trust once a condition has been met, and that condition is clear title, so there's no debt on the property. So once again, the superannuation fund is not in breach because it hasn't got an asset sitting in the super fund that is encumbered, and that's the limited recourse borrowing arrangement. The lender, whether it's a bank or a non-bank lender, they'll lend money to the superannuation fund. The superannuation fund will use that borrowed money and the deposit, etc., from the superannuation fund to actually pay out the vendor, and then a rental agreement is entered into, and you can see that the rental income is paid to the self-managed super fund. The rental income and the contributions that the members make can then be used to actually reduce the debt and make principal and interest payments on the property. Because the fact the superannuation fund is so consistently taxed, it allows for considerable after-tax dollars to go towards reducing the debt on the property, and the property can be paid off a lot quicker than in usual circumstances. So what documents and legal agreements are required? So the list here actually is quite comprehensive. You can actually see there's about 10 or so different legal documents that need to be set up to actually allow this arrangement to occur. It does seem complex, and I think the good thing with Partners Wealth Group is we have the specialists under the one roof to actually allow this to occur quite seamlessly. First of all, statement of advice is a requirement. This is a financial product, so a statement of advice is required from a licensed financial planner to actually make sure that anyone entering into this arrangement understands what they're getting themselves into. You should have cash flows done. There should be a plan B if there's an inability to make contributions, etc. That's important. And also the lenders will not, in most cases, will not provide a loan unless they have a statement of advice from a financial planner. The second dot point there is an updated trust deed, and this sort of is for when there's an existing superannuation fund. It's really important to make sure the trust deed is updated that allows for this to occur, but also making sure that
current superannuation
legislation changes, which we know changes occur quite a lot in self-managed super fund and superannuation, to make sure this arrangement can be undertaken. The superannuation fund will need a corporate trustee. The lenders require that. Superannuation funds can have individual trustees. However, the lenders require a corporate trustee, so that may have to be created. Self-managed superannuation trustee set up, that's if it's a brand new fund being set up. A bare trust has to be set up, and that's the actual where the property sits. That bare trust has to have a corporate trustee, which has to be set up. The limited recourse borrowing arrangement, that's that legal agreement that actually allows everyone to know, the ATO, the State Revenue Office, that the actual superannuation fund is the beneficial owner of the asset sitting in the trust, and that asset can transfer to the self-managed super fund when that condition of release is met, and that is effectively when there's no debt on the property. The bank loan then will come in, and there's obviously loan agreements, whether that's through a bank, a non-bank lender, or a self-funding loan. And with any property purchase, we know you have to have conveyancing and also a lease agreement, whether that's commercial or residential. So quite a lot of
documentation needs to be completed. However,
it can be done quite seamlessly. And once that's all set up, as I mentioned before, effectively, it's just an investment property where rent is collected, debt's repaid, and hopefully the property performs in expectations when you purchased it. So I'll now actually pass over to James Thompson, who's going to provide an update in relation to the lending requirements around a limited recourse borrowing arrangements.
Thanks, Pat. Look, I think the thing to remember here is that LRBAs are a really specialised product, and as such, we've seen in 2018 the big four banks actually pull out of doing these specific loans. So what that's actually meant is that we're left with a couple of key lenders out there in the market, expert lenders that have become really proficient in providing the LRBA advice to clients. And what this means is that these expert lenders have developed a risk appetite and credit policy to actually protect the lender, but then also the client as well, into making the right decision when they're going down this track. And how they do that is through the application process. So it's really 3 steps. And number one is the borrowing capacity. So a client will need to understand, what are the key numbers around a potential, purchase of a property? What are the contributions? What are the repayments? And how does it look like on an ongoing basis? The second part of that is a formal pre-approval. So these expert lenders out there in the market are actually able to generate a formal pre-approval prior to any of the SMSF or the trust deeds being established. So that is a game changer for anyone that's looking to actually purchase out there in the market, by having that pre-approval and having the confidence to go out there and purchase the right property. And lastly is the formal approval. So once the client's found the property, then the transition over, from pre-approval over to formal approval, and then the actual loan facility being established. So that's a little bit about the market and where it sits and for LRBAs at this current point. And the next couple of slides will run through a little bit more about the details into the actual LRBA product. So when we go to look to actually lend, what kind of assets are we looking to do in the LRBA? And the banks assess this under 2 different policies, which would be residential and commercial. From a residential point of view, the types of property you'll be able to purchase would be a residential property, no vacant land, no multiple dwellings on title, and you can do off-the-plan purchases, which we've seen. The other restriction there from a residential point of view will be the rural restrictions around postcodes that are out there in properties. From a commercial perspective, of course, commercial properties are acceptable. We have found lenders that are accepting off-the-plan purchases. The LVR restrictions will come into place with commercial when the property is actually a bit more niche or aged care, and lenders may have a view on that to reduce LVR. From a servicing point of view, so how do we actually service this? Pat's touched on this before. From a residential point of view, it's a maximum LVR of 80%. We've had lenders that will do 30-year loan terms, and really simply is the serviceability that's conducted on these residential products is 80% gross rental, 100% of contributions, and 100% of additional voluntary contributions after tax. The key thing to remember here with residential LRBAs is the liquidity ratio post the purchase. So banks will want to see that there's between a 5 and 10% liquid cash sitting in the pool to safeguard the client if there are any rental shortfalls and to protect against the market. On a commercial point of view, we've found lenders that will lend all the way up to 75% and even 80% in this market from a LVR point of view. Loan terms, again, 30 years, and serviceability is a very, very similar process, very straightforward. So that's a little bit about what the banks are actually looking for and what you can do. But as Pat mentioned before, is that it's really important to understand what the upfront commitment is, but then also, the ongoing costs as well. So when we look at interest rates, which are out there at the moment, from a residential point of view, we're sort of looking between 5.29% all the way up to 6.34% on a variable basis. Of course, these interest rates are going to be LVR dependent. Obviously, the more contribution, the lower the loan, the lower the risk for the lender, and the better interest rate there's going to be. From a commercial perspective, around the 5.8 to 6.34% is where it's sitting in the market. Again, higher maximum loan amount of $5 million, and of course, repayments on a principal and interest or interest-only basis on weekly, monthly, or fortnightly. So that's a little bit about the ongoing costs and how it looks on an ongoing basis. But of course, what's the fees and establishment costs? Out there in the market under the residential policies, we've seen lenders that are looking at a very low cost base of $220 for just a valuation fee, no establishment fee, no annual fee, and no monthly fee ongoing. However, there will be a discharge fee once you discharge the loan. In the commercial space, it's a little bit different. Again, the valuation fee is going to vary. It'll be around the 1% mark for establishment, and then a $6.95 for the SMS review, and this settlement fee as well. So again, it's important to understand not only the ongoing cash flows, but how this is going to impact your cash flow when you go to purchase the property. So that's a little bit about the landscape and where it's sitting at the moment. Partners Wealth Group and the lending division are absolute experts in this industry and help to provide a seamless process for our clients. I'll now hand over to Marianne, who will talk through the duty implications.
Thanks, James. For like any acquisition of property, the process for conveyancing is very, very similar, but it is a little bit different when we have LRBA structures, and that's what I'll be talking today to, including duty. So when you've identified either commercial or residential property which you wish to acquire, you've probably already got your pre-approval, or you're sometime down the track with that. You may or may not have your LRBA documents or structures already established. You've got a contract. We would review the contract for you, identify any issues, and also make sure that it's going to fit, that there are no property issues, there are no contract issues. And if you already have the structure put in place, that the contract has the correct purchaser named, consistent with the LRBR documents. But like any purchase, as I said, there is duty that's payable on the acquisition. In Victoria, there's a sliding scale for duty, and it's calculated to the price. And I put in the slides an indicative duty payable on a purchase price of what we see as the typical purchase price for SMSF being somewhere between $960,000 to $2 million, being at 5.5% of the price. So unfortunately, yes, there is duty payable on acquisition, but once the mortgage has been repaid, there are duty exemptions.
You then transfer the property out of your superannuation fund to a member or beneficiary, then also at that point, there's also no duty implications as well as the duty exempt transaction. If you do have any other questions around the conveyancing, it is a complex process. To talk to the aspect that Pat talked about, double duty, obviously that will only occur where
there's additional consideration payable, and that's more often not the case when you're purchasing in LRBA structures with property. Passing it back to you, Pat.
Good.
Thank you. Thank you, Marianne. I think what's important to note there is making sure the costs are taken are done correctly to split the fault from the bare trust to the self-managed super fund, that it's the State Revenue Office don't deem it to be an additional purchase and additional stamp duty is applied. So that's really important to get the documentation done correctly. So what I'm going to run through now is just a case study, just going through in relation to the structure. So you've gone out, you've got the advice from a financial advisor, you've set all the structures up correctly, you've got your lending in place. But how does this actually look in practice? So the case study we've got here today is just looking at a couple, Joe and Sandra, 50 years of age, wanting to retire in 15 years. Between the two of them, they've got about $250,000 in superannuation, looking at a property worth $500,000. Most probably will be in regional Victoria, and Phil might be able to talk about that in a moment. But just these numbers are just used to show the benefit of actually having a structuring of an asset within that concessionally taxed superannuation environment, and the benefits you get from the fact that the maximum income payable is 15%, the tax on income. Capital gains tax is a maximum 10%, and obviously when people reach preservation age or go into retirement, zero tax on income and capital gains. In this example, we've said that Sandra and Joe actually have $13,000 per annum excess income that they can afford to use towards a strategy to grow their wealth, and their effective tax rate is 34.5%. So they've gone down this path and they've purchased a $500,000 property in a self-managed super fund using the limited recourse borrowing arrangement. We've assumed a 4% rental income. The salary superannuation contribution is about $11,400, and then their salary sacrificing an additional $19,850. So that's that $13,000 of excess income they've got. Because they're not taking that as income when they're salary sacrificing, it means they can actually gross that up to put that into superannuation. There's obviously costs that come out of it. What's the interest rate? We've put 6% here, SMSF fees, etc. But effectively what we're looking at there is about $51,250 worth of income coming into the superannuation fund. And after you take out your expenses, it's only taxed at 15%. So effectively, if you're looking at income of $51,250, you're effectively having an effective tax rate of 8.78%. So the power of that is actually the ability for those tax savings to be used to actually accelerate repayments on the property, and effectively allow for that to be paid off more quickly and benefit when you sell it in that concessionally taxed environment. Just one thing I did mention to say at the start was we are looking to have some questions at the end. So please, if anyone has any questions on what we've spoken about, please send them through into the link that's provided, and we'll be able to answer those questions at the end of the presentation. So what we've done here is an example of whether Sandra and Joe were going to actually look at a personal acquisition of the property or the superannuation fund, and we've just sort of run through the numbers there. And I guess what we're looking to actually sort of highlight here is the fact that the property will actually perform how the property will perform, whether it's owned in the superannuation fund, whether it's owned personally, whether it's owned in a company or a family trust. The capital growth rate is going to be the same and the income is going to be the same. But effectively, how well that property performs is going to be how much tax is paid on the income and the capital gain. So in this example here, we've assumed a 5% growth rate for the property. After 15 years, that $500,000 property is now worth about $990,000, whether it's in person or in the superannuation fund. But how much tax is payable is actually determined by the tax structure. So by the ability to actually have that income only being taxed at 15% as opposed to their marginal tax rate, it means there can be an acceleration of the repayment of the debt. So effectively, after 15 years, the debt is paid off in the superannuation fund. There is a capital gain of $489,000 or $490,000. In the superannuation fund, because they've reached 65 and preservation age, if they were to sell that asset, there is zero tax payable, as opposed to about $42,500 if that asset is owned in their personal name. So the net benefit there by actually entering into this structure through superannuation is about $217,000, which is pretty comprehensive. And obviously, I think if you were to purchase a property with a maybe $1 million, $1.5 million property, as in Melbourne, you would most probably see that difference, most probably prorated for the benefit. So a really powerful way to go about accumulating wealth for Australians, and I think something that most Australians should consider in relation to their wealth creation strategy. So the benefits in a nutshell before I pass over to Phil to give the property updates. What are the benefits of this? I think we've spoken about the tax benefits there. It also, I think in our view, allows you to diversify your superannuation fund assets and not have to use all the cash that's in the fund to actually purchase a commercial or residential property. prior to the limited recourse borrowing arrangements in 2007, if you wanted to buy a property in a superannuation fund, you had to pretty much use all of the assets in the fund. If you had $1 million in the fund and you want to buy $1 million property, well, you had to use all the assets. So by allowing leverage and borrowing, you can actually keep a diversified portfolio of shares. So you're not effectively putting a bet on one asset, one property in one suburb in Melbourne as an example. You're actually allowing diversification within your portfolio. The recourse nature is great. It means that assets aren't going to be taken by the bank in the event of a default. So that provides some protections there. The tax concessions, as I've spoken about, you hold the asset for more than 12 months, only 10% tax within the super fund and 0% in retirement. And obviously the ability to use concessional contributions to accelerate the repayments of that debt. And the other really powerful strategy, and we've seen a lot of our clients do this, and we work with a lot of accountants in relation to business owners, it's the ability for a business owner to go out and buy a commercial property they can then lease that property to their business, and it allows for that business owner to perhaps charge the top end of the rental rate up to 10%. It's the ability to get money out of a company instead of coming out of the corporate tax rate or distribute to a family trust. Is actually coming out and only being taxed at 15% within that superannuation environment. So a really powerful strategy for a business owner to acquire an asset, but also to get money out of the company at a concessionally tax rate. So thank you for that. I'll now pass over to Phil, who'll provide the property update. Over to you, Phil.
Thanks, Patrick. So there's a bit to get through. So we'll start on basically the advice is probably general in nature. So if you want to reach out to us or Patrick individually, more than happy to sit down and talk about your personal situation. So national market update in terms of where we're seeing the residential and commercial markets across Australia. You can see the capital city vacancy rates at the moment are all sub 2% in the main 5 capital cities across Australia. So if you're dealing with a vacancy rate sub 2%, that tells us that we need to go out to our landlords and our clients and aggressively move our rents anywhere between 5 and 15%. Rents haven't moved during COVID. They've probably been dropped by 15 to 20%. We're now in the process of trying to really increase those rents in line and try and keep up with the cash rate movement. If you look at dwelling approvals nationally as well, and we went through COVID, obviously undersupplied significantly in terms of both for units and houses nationally. You can still, we're quite in an undersupply. So everyone that's thinking about there's going to be serious drops in the residential sector, especially in the housing sector across Australia, you've got to be very careful because the markets are very much segmented at the moment and there is value in certain particular capital cities and regionals across Australia. So as you can see in this graph, we're significantly undersupplied. Population movement. So this is a really big one for us. Overseas migration numbers over the last 2 to 3 years during COVID they've been fairly heavily impacted. So we've had no overseas migrants coming to Australia. Usually we deal with anywhere between 150 to 200,000 new overseas migrants coming in, but we haven't seen that. We're expecting about 193,000 people to come into Australia over the next 12 months and about 600,000 to come in over the next 3 years. So it's a pretty significant number. And that'll probably, in terms of that supply and obviously price point, we're probably not concerned around massive drops in the housing sector. We'll touch on Melbourne. Everyone wants to know about Melbourne and what we're doing on the ground and where we're buying. So we've definitely seen a price softening in that sub $7 million pricing housing sector at the moment. We're seeing a demand or an increased demand for renovated homes rather than unrenovated homes. So previously 2 years ago, there was a lot of demand for people buying unrenovated homes and then doing them up as investments or actually buying them as their principal place of residence. We're starting to see particular really good opportunities starting to open up in city fringe prime locations in AAA rated suburbs in that sub $2 million price point sector. So some real value in that particular price point currently. If you look at the affordability index is the percentage of your income going to service home loan debt. We're running around that mid to high 40s. When Melbourne hits an affordability index of around 55%, prices tend to get capped out in terms of our view. So we still think that this market will probably hold up. And obviously with those overseas migrants coming in, we still see some value in particular areas. Price to income ratio, we're seeing the price to income ratio 10 times income. It is getting up there for houses, but if you look at the unit price to income ratio, the probabilities of increases in rents and unit prices moving due to the undersupply issues and the construction sector, the probability there may be some price increases in the unit sector in the older style existing sector that we're looking at. If you look at the median house price, you can see the grey bars are the periods of correction where we've had very little price growth or it's stabilised. The blue bar is where it's gone on a pretty significant growth run. So right now we're just moving into that normal pre-COVID. They've probably accelerated a lot of that price growth pre-COVID. What we're seeing now is the market moving to its general market movement. So we're not particularly concerned about what's happening in the Melbourne landscape, both for houses and units, but it's moving to that cyclical nature that it always has been. Houses versus units, you can see the disproportion and the gap between units and house prices. So we actually think when that gap gets a lot larger, units tend to go on a bit of a run. So right now you can see there's a pretty significant gap between that differential with houses and units right now. Household lending, you can see that there's still fair amounts of activity of people going out there and buying their residential owner-occupier homes. You can see investor lending activities probably dropped off a little bit here in Melbourne, but still healthy amounts of lending occurring across the Melbourne landscape. Stock on market, we're running at reasonable stock levels at the moment. You can see days on market still sub 30 days for an average house to sell, so still pretty strong in our opinion. So stock's moving, but the compromised B and C grade residential stock on main roads, we're really starting to see those particular sorts of assets really start to suffer. Melbourne vacancy rate, we saw the vacancy rate really spike up during COVID. A lot of the student population centres, overseas students, we saw a really sharp increase in areas like Carlton for purpose-built accommodation, but the vacancy rates have actually come down quite significantly over the last, say, 12 months. Other job vacancies at the moment, we're seeing obviously a pretty significant increase. We saw a dip during COVID, but it's really kind of bounced back and, unemployment sub 5% in Melbourne, so extremely healthy. A lot of job vacancies that we're seeing both in the private and public sector in terms of available employment. So that's a really, really healthy sign that we don't see things slowing down too much. Look at Perth. We've never really liked Perth as a business because it's been very volatile. It's always been tended to be very mining dominated and commodities dominated. But if you look at the affordability index in Perth in comparison to Melbourne, you can see the affordability index is running at 25%. So 25% of your income is going to service home loan debt. And if you look at the average incomes in Perth, they're on par with Sydney. So the Perth market has had 13 years of no growth. You can see that the price to income ratio in comparison to Melbourne and Sydney, we're running at less than 6 times income for housing and units. For units, if you want to actually go and buy a unit in Perth, it's actually cheaper to buy than rent currently. We don't buy any units as a business. We don't buy any off the plan type assets. We only concentrate on really good quality housing across the capital cities and top 30 population centres. Perth median house price, this is a really big graph because you can see the period of correction. There's been a really, really long period of correction for 13 years. So if you purchased an asset in Perth in Subiaco or a AAA rated suburb for $600,000 back in 2008, you would have made very little money over the last 13 years. So we actually think there's a fairly significant opportunity for our client base in the investment sector, and that's probably a market that we're concentrating in and buying anywhere between 50 and 60 houses a month on the ground. Houses versus units, we still think we should be concentrating on the housing sector in Perth at the moment, so we're just going to concentrate on that and stay away from the unit market. Stock on market, you can see this is a really big one for us because the McGowan government came out and basically kept a lot of the Perth and WA population living in WA. He's gone on a very aggressive campaign to recruit interstate migrants. What we're going to see over the next 12 to 24 months is 70,000 interstate migrants moving into Perth over the next 12 to 24 months. And you can see the availability of stock on the market is only running at 20,000 dwellings. So there's clearly not enough stock to cater for that demand. And if you look at the vacancy rate at the moment, the vacancy rate's sub 1%. It's running at 0.6% at the moment. So you can see owner-occupier lending activities really increased over the last 2 or 3 years, and it's also starting to pick up in the investment lending sector as well. So we're seeing strong amounts of owner-occupiers buying their homes, people from New South Wales and Victoria moving over to Perth, strong employment opportunities on the ground. We've got an unemployment rate of 4.2% in Perth at the moment. So very, very low and attractive if you're looking to move over there for lifestyle reasons. Vacancy rate, again, I just touched on this before, but you've seen the really big increase in rents in the housing sector. You've seen rents jump anywhere between $50 to $100 a week for an average house. And for the first time in 6 years, we've actually seen rents in the unit sector starting to increase. So that vacancy rate is probably one of the lowest vacancy rates in the country. And provided it stays at that level, we'd probably still see rents increasing. Job vacancies, again, it's actually stronger than Melbourne at the moment. So again, dipped during COVID, but at all-time highs. We haven't seen it this high in terms of the amount of employment opportunities on the ground. And then getting back to a national standpoint, Patrick touched on before, buying assets at $500,000 in the super fund has become a lot harder for us as a business. There are a few regionals left that we can actually undertake those particular purchases for our clients, but as a business, we grade every suburb in Australia as a AAA, triple B, triple C and triple D. What you really want to be holding in the portfolio for a super fund purchase is a growth focus, good quality residential housing type assets that you can hold for 10 years plus. Adelaide and Brisbane, we're seeing a lot of value within those markets. The Perth market, we're seeing a lot of value. From a regional standpoint, Toowoomba, which is about an hour and a half out from Brisbane, we're seeing a lot of value in that particular market, and Ipswich in Brisbane as well. So these are our probabilities. This is the graph that, the slideshow that everyone loves to look at in detail. So if the cash rate increases, we had a 50 basis point cash rate increase yesterday, and you can see if the cash rate gets to 3.5 or 4.5, you can see the variable rate's going to sit anywhere between 5 and 6%. So these are the probabilities that we're forecasting in terms of what's going to happen to Melbourne, Sydney, Brisbane, Perth, Adelaide. And if you look at Perth, of all the capital city markets across Australia, you can see in terms of the potential price growth that we probably see in that market. If you're taking a long-term view, we probably still feel that there's really great value in that sub $2 million market in Melbourne. We're not touching Sydney currently because we do expect some price falls within the housing sector in that market. But if you actually want to go and buy a really good quality asset in the super fund, we're doing a lot of those in Brisbane, Adelaide, Perth and Melbourne currently. Commercial update, we'll quickly do a snapshot on the commercial landscape. So Melbourne in particular in the healthcare sector has been very, very strong. Triple B and triple C rated assets are really starting to struggle. So if you don't have a really good quality tenant in your commercial building, or they're really starting to struggle. So us as a business, we actually go and locate particular tenants that we can put into these vacant buildings and actually buy those particular assets at a discount. We actually think there's some really good opportunities for our business owners and doctors to actually start acquiring their principal place of businesses now. So we're actually advising them to get their funding in place, get their LRBAs in place, get all the back end sorted out first with a view of actually starting to purchase these assets over the next 12 months. There's a real gap between what the landlord, when they put that commercial property on the market, and what an investor expects to buy that property. So at the moment, an investor wants to buy that particular asset on a 5.5 or 6% yield. And the landlord or the vendor that's looking to sell that particular property is still chasing a sub 4% yield. So we're actually seeing that market. There's a bit of patience out there that we're advising our investors to take right now. Yield state by state. So you can see there's been a really strong push for Bunnings, essential services, defensive type assets, medical assets. So yields across the country, especially in Melbourne and Sydney, are sub 4%. So if you want to go and buy a really good quality industrial property or a commercial asset as an investment, you're really looking at anywhere between 4 and 4.5% for that particular asset. So we do feel there's better value in other markets across Australia rather than Melbourne and Sydney right now if you're looking to buy an investment within the SMSF. So right now, in terms of our strategies that we're advising our clients, if you want to go and buy a really good quality residential asset, in the SMSF, our suggestion is that you focus on growth. You buy an asset with a really good proportion of land backed against that asset. We're undertaking a lot of principal place of businesses purchases across the country. So a lot of our industrial business owners, we're buying their industrial sheds. A lot of our doctors, we're buying their medical clinics. A lot of GPs are getting into partnership, and we're looking at particular assets that we can renovate and value add along the way. But if you're looking at buying something within the SMSF, it has to be attractive and it has to generate a reasonable amount of income as well, because it's an investment at the end of the day. So I think we'll probably run through a couple of examples that we've purchased in the last 6 months. So we've done a couple for your clients recently, Patrick. This is one of your clients actually that we recently purchased for. Really good quality property. Client had a budget of around 1.5. We were able to secure it just under that. This was a property, anywhere 6 kilometres out from the Brisbane CBD. Well renovated, very attractive to tenants. We ended up getting at least within 8 days of it going on the market, but in very, very good condition in a great suburb. This was one that we recently just purchased last week for a client, again in the SMSF, 1,000 square metre allotment. So the asset actually had the ability to develop. We actually can't develop within the super fund. We've got to be very careful what we do advise that client to do on that particular asset, but great property, good suburb, very easily rentable in its current condition. This was another one, more of a beachside type asset, good land holding, renovated all the way through, taking a position, again, sub 1.5 and a really, really attractive asset that will appeal to tenants. On the commercial landscape, we had a doctor the other day that came in and said we want to go and buy a healthcare asset within the super fund. We ended up picking this particular asset in North Hobart, again, 1 kilometre from the water, prime location, again, rented out to 3 healthcare practitioners, 5% yield from day one, and in really, really good condition already. This was a property that we purchased in WA, again in the SMSF, leased out to, this was a police headquarters, government-backed asset. We secured a long-term lease on behalf of those particular tenants, so negotiated a really long-term lease. Good quality property as well, and very little renovation or capex required on the building. And last, this is one that we recently purchased for an industrial principal place of business owner. He'd been looking himself for 12 months, couldn't find anything. We ended up negotiating this just above 5 mil. They're going to move into it in the next 12 months. And again, a really prime asset for a principal place of business owners that we're able to secure. I'll hand it over to Patrick for any questions. So thanks, Patrick.
Thanks, Phil. Always comprehensive. So now we have a moment to have a few questions, and Alex Swanson will be joining me. Alex is our head of superannuation and is an expert around superannuation. Alex oversees the audit of over 2,500 funds a year, and also the administration and financials of 400 SMSFs. So thanks, Alex, for joining us. So thank you for those that sent the questions through. A few of those. The first one, I think I can actually throw to you, Alex. The question is, and I think Phil touched on this, can you renovate or develop a property that you acquire using a limited recourse borrowing arrangement?
Not until the loan has been paid off. So if you think about it, probably holding your super for 20 odd years, and you find a property with a lot of land, once the loan has been paid off, then you're unrestricted on what you want to do with the property. But while the loan is attached to that property, you're very limited. You can do some minor renovations. You can change the paints and update, but you can't change the structure of the property.
Okay, thank you. The next question that came through was in relation to when purchasing a commercial property using a limited recourse borrowing arrangement, what are the liquidity requirements? So with a commercial property, the lender usually requires a lower LVR or a higher deposit. So that means that the liquidity requirements aren't as onerous as a residential property. So you're looking at perhaps 5 to 10% liquidity requirements. However, in speaking with James in relation to this. I think it's important just to sit down, speak with the lender first and understand what their requirements are. We have seen limited recourse borrowing arrangements with the commercial properties with minimal liquidity requirements, given the deposit is quite high and the LVR is low. The next question that's come through, always a good question, is how long does it take to set up the structures? The first thing we would say is always talk to the lender first to make sure that you can afford the structuring. From my experience, it can be set up quite quickly, the actual structures, even though there's 10 or so structures which need to be set up. It can happen quite quickly. What I do see some issues in relation to number one, people will go out and sign a contract of sale and or nominee when the structures are not set up, so that can cause issues in relation to the State Revenue Office. Also, if the superannuation fund isn't set up, you have to be rolling money out of an industry fund or a retail fund, and that could take a while. So it's really important to understand that the money's got to be in this SMSF for you to make the deposit, etc. So what we say to clients is that, number one, it's important to have the lending pre-approval, have the structure set up before you go and sign a contract. But in the case that that happens, we always recommend clients, sign and or nominee and try to go for a minimum 90-day settlement to allow for any unforeseen circumstances to be dealt with. Okay, the next question which has come through hot off the press is, can you borrow for a vacant commercial property? Now, I think that's a good question, and there must be two areas there. I think number one, and I'll go first in relation to the lending, I think the lender will obviously look to see if there's an ability for that to be rented out, and I think if they can see that the serviceability works, they will lend on that. So the property does not have to be tenanted at the time that the settlement occurs. However, the lender will want to make sure that there's an ability to rent that property at a market rate rent. Also, they'll look at the ability of the trustees and the members to actually contribute contributions, and in that circumstance, it may go back to the previous question in relation to they may require a high level of liquidity to actually force, see us through any periods where the property has taken longer to rent. And that question actually does tie into another question that's come through, and the question is in relation to GST, Alex. Do you pay GST on a commercial property when you buy it in a superannuation fund?
Yes, so commercial property attracts GST. However, you can register the super fund for GST and claim the GST back. You're required to register for GST if the GST is greater than your turnover is greater than $75,000. But there's certainly to register for GST is not an onerous process.
Okay. And on top of that, the question in relation to if you were to buy the property and it's a going concern, what are the GST implications then?
Well, so again, there'll be GST attached to the business, but again, if you register for GST, you can claim the GST back.
Okay, fantastic, thank you. The next question here is, with the legislation changes, do you see any issues in relation to any type of property, i.e., off the plan?
Yes,
commercial, residential.
Yeah, look, Labor, we don't know exactly what Labor's planning, and when they introduced this legislation, the proposal back in 2019, a lot of industry analysts were trying to work out what's the date that the grandfathering would start, and the consensus seemed to be the date that the LRBA loan was signed. So if you're looking at buying a property off the plan with potentially 18 months, 2 years before the property is developed, there could be a risk that the LRBA legislation may not be available to you. So it's important to probably wait until we have the budget, which is the 25th of October. But even so, there'll be a budget next year as well. So we don't know when this legislation comes in. So it's probably prudent to look at established properties in the short term until we have a better idea of what the framework is.
Yeah. Thanks, Alex. Another question is, can I use the structure after I've gone through and completed one transaction, i.e. the property transfers to the superannuation fund? Can I reuse the bare trust and the limited recourse borrowing arrangement?
Look, the bare trust is set up to hold one asset. It's preference to, if you wanted to buy another property, to set up an additional bare trust because the documents are all linked to that one property. However, the bare trustee company can be used for multiple trusts. So our preference would be to set up a separate trust for every property. Reusing a trust can be problematic.
Okay. Thanks, Alex. A question that's come through in relation to Phil. Does Phil act as a buyer's agent? Yes, that's correct. performance property are buyers advocates, and I guess from our perspective in our business, we identified that our clients were making some poor property decisions, and that's why we sort of formed a relationship with performance property over 10 years ago. And we've found that that's been excellent outcomes for our clients, where they can go there and get impartial advice in relation to purchasing property. We've seen them, avoiding some of those pitfalls that some clients make, unfortunately, when they go out to purchase property. It could be a high pressure sales environment, or we know that clients are busy, running businesses, working in professions. It's very hard to do the research on property, to go out and actually purchase a property, make the right decisions. So they are buyers advocates. Next question is in relation to ongoing and regular advice once set up. How important is ongoing and regular advice once the structure is set up? So I think there's two components there. Number one, I think obviously the superannuation fund is required to lodge annual tax returns and be audited and have the financials done. So really important to engage a professional there, whether it's Nick, your accountant, or Alex and his team. Secondly, I do think it's important to have an ongoing relationship once the structure is set up, because every year it's really important to look at the contribution strategy, the liquidity of the fund, the cash flows. Also, taking on debt brings additional risk in relation to if something was to happen to the people contributed to the fund. How's the debt going to be taken care of in the event of death, disablement, or permanent disablement? So really important in our view to have that ongoing review every year to make sure that the strategy is on track and tracking against how it was planned to do, because there's also legislative changes that occur, etc. Governments usually flag legislative changes, hence what we're talking about today, 2019. The Labor government did it at the election. So really important to have that ongoing relationship with a professional advisor. So I think that brings us to an end of the questions, unless there's any more. Sorry, there's one more coming. So that will be coming shortly. So thank you for those that have sent those through. While I wait for that question to come through, I think today what we're really trying to achieve and the importance of this webinar was really to get people to think about if they want to undertake this strategy as wealth creation, which we know works really well. We think now's the time to act, given the uncertainty in relation to the federal budget that's coming out in October. So Partners Wealth Group, we'd be happy to take any calls, etc., and have a complimentary meeting to understand your circumstances and see if we can assist you if this strategy is appropriate. This is a good question. We get this all the time in relation to the residential property. Who can live in the residential property? And I guess the question we always get is, can I live in the residential property? And a lot of times this is when the clients purchase a beach house down Sorrento way. So Alex, you might want to talk to this.
Well, it can be a retirement strategy. However, you cannot live there while it's in the super fund. So you'll have to wait until you retire, then transfer the property out of your super fund, and then you can live in the property. But while the property is in your super fund, a related party cannot live in that property, unfortunately.
Yep. And I guess on the SIS legislation, superannuation is there to provide for your retirement benefits. So even on retirement, if you wanted to use that property as your principal place of residence, you'll have to move the property out of the fund. Alex?
Correct. And you can be eligible for some stamp duty offsets as well.
Yep.
So.
Great. And the question just coming through to clarify the GST at purchase for commercial. I think something to cover off there is if it is purchased as a going concern, there's no need to fund the GST.
Because we can, yeah.
Correct, yes. So if it's purchased and it's not a going concern, you'll have to pay the GST, but you can get that refunded. So that's another additional cost to outlay, even though you're getting the money back. However, if it's a going concern, Alex, do you want to just confirm that?
Yeah, that's right. Yeah, so it again, that also depends on the size of the fund as well.
Correct.
The fund might also be generating enough income from the rent.
Yep.
So it may be registered for GST anyway.
Yeah, correct. So an example I would use before we finish today is we've had clients who were looking to purchase a property to be the tenant, be the commercial tenant of that premises, and they actually entered into a lease agreement before they purchased the property to allow them not to have to find the money to fund the GST, even though they would get the GST back in the event they purchased it. It just allowed for them to actually settle on that transaction and not have to fund 10% of the purchase price. Great. Okay, well, I think that we've sort of come on to our time today. So thank you everyone for your attendance. Appreciate everyone dialing in. Hopefully that's been a useful webinar for you in relation to limited recourse borrowing arrangements. As I mentioned previously, we're more than happy to take any inquiries and have a complimentary meeting with anyone who's looking to actually undertake this strategy. Thank you again. Thank you.